All right, guys. So we have with us today Arnaut. Arnaut, welcome back to F.A.C.E. Arnaut does Elliott Wave work. He has a company. His handle's at Intel_invest. And welcome back, my trading warrior brother. How are you?
Hey Dale, good morning. I'm doing great, even though it's quite early and almost before my usual wake
Oh,
up
are
and go
you
time.
where are you that it's early for you? Are
And
you in
I'm on the
California?
east. I'm in the East Coast, just like you.
The
Sorry, yeah, West
West.
Coast. Sorry, it's so early. I got
Oh,
I got my geology
anyway,
confused.
how,
West Coast.
so Arnaud for sure.
Yes,
You know for sure you're on the West Coast if you're up early, baby. So
yes.
anyway, let's talk about some of the wave patterns and things that you're seeing and what you're sharing with your subscribers and people that you're teaching and that follow you. Okay, so this is a
That sounds like
what?
this is just a general Elliott wave pattern. I thought I'd put it up there with my company logo. Of course, got to promote myself, but don't worry about that.
Yeah,
It's
sure.
this is the general Elliott wave pattern where we are most of the time looking for 5 waves, in this case higher, and 3 waves up, which are the dominant pattern is 5 and the corrective pattern is 3. So all the ones, the 3s and the 5s are smaller 5 waves, they subdivide, whereas all the 2s and the 4s are corrective patterns, so they are 3 waves. And we
Right.
can turn this upside down as well. In a bear market, for example, you most of the time have 5 waves lower and 3 waves back up. And in the bull market, you have the way I'm showing it. But since most of the people prefer, of course, to look from low to high, this is the preferred way, of course, to plot a chart. But
Okay,
once
so
we are,
so a lot of people are embraced the range narrative. 4,200, 3,800. They're even putting their money where their mouth is. They're selling calls, 4,200 calls, and they were selling 3,800 puts. Are we
mm-hmm.
in a new bull market, Arno? And we're about to bust out
No,
this range?
no,
Huh?
no. That's a very good question, Dale, because that gets me actually to my third slide. My presentation is 2 parts. The first part is about the major US stock markets. And
Okay.
I think,
I'm
in
sorry
my
I
humble opinion,
interrupted you, but
that's okay.
I'm just hearing a lot of melt up narratives creeping back into it. 5,400, 6,000. Um,
Mm,
I
no,
think
I'm
that
not seeing it.
I think that could happen, but I still think we have to take out those October lows before something like that happens. I'm
I, I
very interested in what you're seeing here.
I think you're absolutely right. Might be because you've talked to me before, but
What's that?
because you've talked with me before. And I think, as I have read, is as a little bit of a warning that the stock market is getting closer and closer to completing a larger counter trend rally. So the
Okay.
dominant direction of those Elliott wave pattern we saw is now to the downside. It used to be to the upside, but we're now in a bear market. And the bear market should last quite a while and is probably longer and more severe than we've ever seen before, as I think we're in what we call a super cycle. You can call it a cycle, but a 4 wave, which is of a degree we've not seen in this market ever. That's pretty much where we're at. It's comparable to what we saw in the 1920s when the market topped in the 1929 and we got the crash into the 1930s. But that one was very fast and furious. And we are now in a 4th wave, which is most of the time more confusing and overlapping, something akin to what we saw in the late 60s from 68 to 74. There, the market kind of went sideways
Yeah.
down for almost 10 years. But before I go back, I always want to make sure that people remember that my work, and actually that's of any other analyst's work, is never 100% accurate. So we got to have realistic expectations, right? So I'm no guru, I'm no market god that knows everything, and nobody does. I'm not a prophet. So if we have realistic expectations, we can't expect perfection. We cannot ever expect only accurate calls, because we're dealing with a very dynamic environment where there's millions of variables that go in. And was just listening into your previous session with Blake, where he says also with technical analysis, it's not always right, but you try to anticipate, monitor, and adjust. And when the data changes, when you're looking higher but the market goes lower, you adjust accordingly, right? So you use a scientific process. We don't get stuck to a certain narrative and opinion. We are until proven otherwise. Anyway, that brings me back to where I think we currently are. And so far, it's been playing out reasonably well. I forecasted this larger bear market already in the summer of last year. Here's an article of mine.
You also called this rally, Arnaud, last time you were on. You were constructive. That's probably why I led off with, are you even more constructive, and are we in a new bull market? So.
Well, maybe we are, but I'll get to that in a moment. Why I think we're not in more detail. But so this was back in June of last year. So I even said we can actually potentially reach 5,000 in the bear market. Well, everybody, of course, calls me crazy, but that was actually possible in the 70s as well. And this is the article I wrote for investing.com. It's June 17, 2022. I do want to make sure that what I say is well established, that I'm just not pulling things out of my hat. And what I'm comparing the current.
You don't wear a hat. Your hair's too good.
I don't wear a hat, no.
All right, go ahead, buddy.
Thank you. We should be in some sort of regime here, as I pointed out, from the 60s into the 70s. We kind of have a similar economy where the job market was tight. We started to get inflation, high interest rates, that type of stuff. And we're currently probably filling in a similar pattern. Now, I mentioned that it was like a larger fourth wave. You see this Roman red number 4. Which is of a pattern that is quite similar to this blue 4 and this purple 4, let's call it purple, and this other blue 4. And all of those were fourth waves. And all of those were of a kind that we call irregular expanded. Now, we don't need to know exactly what that pattern is, just that we have seen these fourth waves at different degrees before in the stock market, and they all had a similar type of pattern. Even this little black 4 here, sorry if it's maybe a little hard to see, was also, as a little overlap here with the labeling, again, a fourth wave of a flat. Second waves since the 1930s, here's the market crash in 1929, 1933 or 32, zigzag, zigzag, zigzag. It's a certain pattern, whereas those were second waves. Fourth waves were flat, flat, flat. So if we are now in the fourth wave, and so far the market is behaving as it is, then it should be also a irregular expanded flat. Back in June, I thought, it's hard to see here, we would drop here to about 3,000, 29.91. I think we got to as low as 3,200 in October, something like that.
34.50.
34.50. And then I thought we would go back to at least 3,700. So we've already surpassed it. So that has worked out reasonably well. And once we top here, though with further analysis, so this is a very crude map, right? This is very crude, just to kind of give people an idea of what to expect over the next, as you can see here, 10 years, we're going into the 2030s before we're going to go lower. And then, of course, you can fill that in with more color. So here is more details, zoomed in view of the S&P 500. So we have the same labels, right? The red 4, the blue 4, and this is the blue A, the blue B, you see. So this wave 4 is what we're going to call subdivided. Remember, the corrective waves were 3 waves, A, B, C. That's what we had on the very first slide. And we had impulses to the upside, 4, 5. So we're now subdividing this larger fourth wave in 3 waves. Those 3 waves are going to subdivide into smaller waves. It's going to subdivide into smaller waves. Right? That's the fractal nature of the market. And we bottomed here at around, I believe, 3,500, ABC higher. We should now be working on this black C wave. Potentially might have already topped, but I prefer to view this as still going on into later this year. And I'll show you the narrative why, which is important for people, I think, to understand. We are in what this is a counter trend rally. So I showed you in June, we laid out that we would bottom at around 3,000, rally to at least 3,700 and then back, and we got 3,500 and a little bit over 4,000. So not too bad of a very crude roadmap. Filling it in, we should top here between 4,100 and 4,500. So, as you mentioned, are we going to see a melt up to 6,000? Not yet. I don't think we'll see one until much later this decade. And this would fit with the 1970s, what we've seen before. This is called irregular because this B wave is going to go to a new all-time high.
I see.
Why do I think that is? Based on previous patterns we've seen. For all these fourth waves, they've pretty much all been irregular. So it's logical to assume, we can't know for sure, but logical to assume that if all the other previous fourth waves were irregular, this one should be probably irregular as well. The other thing is that from a Fibonacci Elliott wave point of view, the top we made early 2022 fell a little bit short. Others, and me included, and others meaning other Elliott wave analysts that I highly respect and are really, really good, we're looking into the low 5,000s, and we never really got there. So something is missing. Then I always say the B wave will do the trick. If the third wave doesn't get there, the B wave will do the trick. I've seen it so many times with so many varying degrees, and I keep telling it to my members. I say, well, this third wave should actually go based on this standard pattern that I showed at the beginning of our interview. Should go to this certain level. It didn't. It fell a little bit short. For whatever reason, it fell a little bit short. It wasn't picture perfect. And then most of the time, the B wave will do the trick to kind of fulfill its destiny, right, to say so. Anyway, so we should now be
the irregulars trick up a lot. Really,
oh, they do. They are really tricky.
Yeah, because, well, they think, market participants think that you're getting a breakout, and all it is, and they don't understand that a B wave can take out an A wave high and still be an ABC.
Correct.
So
correct.
Read about them, because you see a lot of those, don't you, Arnout?
Absolutely. So the last one we had was actually the top here in 2020. That was a B wave top, and then we got the devastating coronavirus crash. Yeah. The coronavirus crash was a picture perfect 5 waves that followed the Fibonacci impulse pattern to the downside, picture perfectly with wave 3, 4, and 5 nailing every single Fibonacci extension. It was absolutely Elliott wave beauty, and very easy to forecast once you figured out, oh, we are in 5 waves lower. It did wrong for me. I thought this larger fourth wave had already happened. But again, so we went to new all-time highs, and then the coronavirus hit. But the good thing is, if you take profits and have your stops in place, you don't have to worry at all about, of course, a crash like this. You'll be on the safe side of things. But that's a whole different path we can talk about.
So you don't think anything can happen until next year, at least to the downs. The crash is next year.
Correct. So again, this is a little bit of a rough roadmap. I've had this roadmap for my members again since June, and it's filled in pretty nicely. I have barely moved the A, B, and C labels. I've barely moved the actual lines, and I'll show you also why.
Did we already have the little B? And we're in C now?
Yes. So we completed this larger blue A wave, and we completed this black A, we completed the black B. So that was, I think, the earlier lows.
3,800. SVB crisis there. Is that your line in the sand for this count now?
Pretty much. And the current market environment we've had since October is quite typical for a B wave. It's very overlapping. We haven't made much progress since the last 4 months. Actually, we're kind of stuck below 4,200. So careful again. Once we get above it and we get too bullish and sucked in, then the C wave will happen. Anyway, so that was forecasted last summer. Then, if you might recall, since October, we said we'll turn bullish if we break above a key level, which was about 3,900, 3,887 to be exact. And the current rally is that hallmark of a counter trend rally, and they're harder to forecast because they're so overlapping. It's A up, B down, C up, and then another A down, B up, C down, etc. But it's really messy, so it's a little harder to forecast. They're a little less reliable. And that also means from a trading perspective, you should not just go full in. You should trade, I would say, shorter time frames, smaller positions, take profits quicker.
Be more tactical.
Exactly. Be more tactical. The time of your buy, hold, and wait till your nose start bleeding is, in my humble opinion, over. Now, I don't want to give anybody any trading advice, but you have to adapt to the market environment. Your trading and investing style need to adapt. So this was October last year. I said, was the S&P 500 still on track? I was wondering if that would be the case. But again, in October, we said October 12th that we have to, if you see here on the right, if you can see my cursor, that we have to stay below 38.87. If we didn't back then, that would throw a wrench in the bear's work, and we would start a multi-month bear market of a rally, which would challenge the August highs. And here we are, we broke above 38.87. So that's the beauty of the Elliott wave. If you have these key levels that you know that if they get broken to the upside or downside, it invalidates a certain pattern you're tracking. So we were tracking a certain pattern to the downside that if it would continue, could target to about 3,300. Well, it didn't happen. Instead, we went higher, and that was our cue to look for a much larger multi-month rally. That was already in October. So the foresight you can have with Elliott wave is amazing. Now, this doesn't tell us exactly where things will top and bottom before that, but again, you can start to draw a rough roadmap, right? Once you know we've broken above a certain key level, you can start drawing in a larger roadmap. So that gives us then today's.
When's your GAN date this year?
I'll get to that in a minute.
Okay, I just saw it.
I'll get to that.
Do you make anything out of eclipses?
No, I don't. No, I don't.
All right.
I don't. I should. I mean, there's so many interesting things that impact the markets.
There's one Thursday.
Oh, interesting. Let's see how that plays out.
Pretty rare one. Okay.
Yeah. So anyway, so we have here our rally since the October 13 low. And so the article I wrote here was October 12th. Not too bad.
Yeah.
Kind of a little bit of a foresight. And again, we broke above this 38.87 level. We did, which is here at some point. And since then, as you can see, it's really messy. This is overlapping, right? It sees up, down, and we're not having this clean look at the pattern like here from August into October. We see a nice, pretty much clean impulse down. 1, 2, 3, 4, 5. This is 1. This is 3. This is 4. 4 doesn't overlap with 1. This is a picture perfect impulse lower, a C wave. And ever since, this has been messy, up, down, up, down. By the time we were in March, we were back to December. We were back into October. Not much progress. The market is not making progress. This is a counter trend now. Smaller, I think we're going to get closer to a little bit of a local top, somewhere around 4,200. So we're getting close. We should see a pullback for this wave 4 and then a final wave 5. Why? Because this is also a C wave. Just like we had a C wave here from August into October to the downside, we should now see a C wave here since the March 13 low. So the March 13 low, I think is very, very important. There are a little bit fewer degree or lower degree levels to watch as well that already start to give warning signs that the uptrend has ended. But again, you can see many twists and turns that are all what we call APCs. It's hard to follow. It's kind of erratic. So if it's erratic, then your certainty of your forecast decreases, which is okay. You have to accept and acknowledge the environment we're in has nothing to do with the analyst. It's simply that the market is just a little less predictable. And that's just the way it is. And if you do that, then you can adjust your trading, as we talked about. But otherwise, we're still in a bullish regime. I'm still looking for higher prices to about 4,300. I mean, technically, we're above the 20-day moving average, the green moving line, the 50-day, the 200-day. They're all moving up. I haven't plotted in. I looked at, for example, the Ichimoku cloud. We're above that cloud as well, which is also a trend following Trump. Trend. And compare that to where we were, here in the summer of last year, below the 200-day, pretty much most of the time below the 50-day, below the 20-day. This is a bear market. And I call this the trend is your friend. And if we are below these moving averages most of the time, it's a bear market. The trend is, in this case, to the downside, and the downside is your friend. And now we can see we've really, truly changed the trend to up. So I think it's prudent to now be more of a dip buyer than a rip seller. You used to sell the rips, and now you should start buy the dips. But again, with in mind that we are most likely in a counter trend market rally until proven otherwise.
Okay.
And this has not changed since October. I've had this since October, and so far it's been behaving as a counter trend rally, overlapping nasty.
What? Okay.
Yeah, go ahead.
No, go ahead.
Okay. So I think also, sorry for the typo, it's a disconnect. There's a disconnect between indexes. The rising tide does not seem to lift all the boats.
Yeah.
I mean, the small caps are pretty much where they were in October last year. And the
Right.
large cap and the mega cap, I heard you talk about it with Blake, are not, right? They're kind of holding up the market right now. The
They
mega
are
cap.
8 stocks.
Yes. Yes. So there's this large sector rotation going on, sometimes almost on a daily basis. And we need to see all the sectors of the economy doing well. And apparently the market says the small caps are not doing well, which I think are the bread and butter of our economy. Most people are employed by small cap companies, not by actually mega cap companies. So the market is saying something that can that change? Yes, it can, but right now I'm not seeing it. I don't like the small caps. Meanwhile, as you mentioned as well with NVIDIA, the semiconductors have rallied tremendously. So that's not something that's normal, in my humble opinion. So there's this disconnect. There's no rising tide lifting all the boats. So we should be a little more cautious. And there are bull traders and old traders, but there are no old bull traders. So it's time to be cautious, and it never hurts to be cautious. So then we're going to go to the last point: seasonality, the oil Dow Jones relationship, and gone. And they all point to a top this year. If you have a few minutes, we'll go over it. So this is seasonality, the average of, in this case, I believe 36 or 40 plus data points for the Dow Jones during pre-election years. Right? We're currently in a pre-election year. I kind of want to compare apples to apples and not just look at a general average. And this one is looking for a rally into late April, early May. Correction, and then another rally into July, potentially September. We kind of have a double top. Now, this is not about the amplitude, the exact, percent gain. It's about the direction. So we should see a top in April, a drop in May, etc. So it's about the pattern, not exact about the percentages. We shouldn't think of, oh, it went from 6% to 7%, the Dow Jones. No, that doesn't matter. And it's worked out reasonably well so far this year. Doesn't nail all the turn dates exactly. It's an average, but this is a general detailed roadmap. So most of the time we'll have that saying, right? Sell in May and go away.
Yes.
Seems to be the case, but we might see a summer top. Most of the time kind of markets do on average rally into the summer, low volume months. And then of course we get seasonal weakness into September, October, when most of the bigger money managers return from the Hamptons and start selling what all their interns have made during the summer. That's kind of how it works. Yeah. So if we then look at another relationship, it's the oil Dow Jones relationship. And this was found, and it's publicly available by Tom McClellan from McClellan Financial Publications. And he shows that what the crude oil did 10 years ago will eventually echo in the Dow Jones. And this relationship we found has held up with, of course, some variability for 120 years. And it's not exactly 10 years. It's not like on the date, but pretty rough. Within a couple of months, you will see that when oil topped in 2008, then the market will see a correction in 2018 and vice versa. And this is type of similar, that we're not looking at the exact amplitude of the moves in oil, but about the direction. So I found this, and it's doing really well. So Tom went back all the way to the early 1900s and found that this relationship holds up most of the time. Again, nothing works all the time, right? Nothing works all the time in the markets. There are some exogenous events that kind of throw things off. Whatever happens, it's fine. But if it happens most of the time, I think you should pay attention and use it to the best of your ability. So that then brings me to that relationship, which if we zoom in to what oil did 10 years ago, which is of course 2013, we see here in 2012, if we go back even another year, that oil topped in February 2012. When did the Dow Jones top? January 2022. That's pretty darn close. And since then, you can see oil has been quite messy, overlapping counter trend rally. And it shows us we should see a counter trend rally somewhere into June, July. All right, that fits kind of well here with average seasonality. That fits well with the fact that we're still looking for higher prices, local top, but not the top just yet. And again, this slide is just made for price relationship, not time relationship. I'm just trying to work with the space available. A lot of people always ask me, oh, so you see a low in May? Yeah, it's possible, but I'm just trying to put things into, you know,
Right. Okay.
allowed space. Otherwise, it's not easy to read anymore. And then we should see a big crash starting in 2014. So this one. Again, this relationship is held for 120 years. So I think we should listen. That fits with the added wave, correct? The C wave that I'm looking for. It starts to fit here with seasonality into November. Negative, down. So all of it starts to line up. Whatever the reason is, the why, I don't care about. I cannot predict the future. I don't know what this exogenous event will be. I just view it from a technical point of view. We've exhausted the counter trend rally, and then the downside side will continue. The last little piece of evidence we can find for this is by Gahn. You were looking already at it, who forecasted that we see a major panic crash 2024. I know it's maybe a little hard to read, but here's 2024. Again, I'm sure we can find dates in this table that are wrong, that have been wrong, that there was no top or no crash. But Mr. Gahn was looking for a extreme low. This is since the 1930s, for those that are not familiar with Mr. Gahn. He uses certain time price symmetry relationships, I think even planetary based relationships to come to forecast where the market should top and bottom. This is very crude because it doesn't tell you when the market will top or when the market will bottom. For example, 2022, very high stock prices. Correct? We made the all-time high in January 4th, 2022. That was it. So again, a crash in 2024 can be anywhere between January the 1st and December 31st. You don't know when it starts and where it ends. But it gives us an idea to expect a crash in 2024. He was looking for extreme low stock prices in 2009, high stock price 2013. Everything went well. 15, 16 were the pre-Donald Trump corrective price action, etc. So again, there's certain dates, low stock prices 2003, correct. There's some dates I'm sure that didn't match. That's fine. If you correct 80% of the time, I'm listening. That gives us very good odds. And again, this lines up 2024, we'll see a crash, matches with oil. And again, oil is looking for not until the crash to happen almost over a year from now. But again, this is all plus or minus a couple of months. This is a very rough roadmap. But something is coming and it ain't pretty. Let's put it like that. So that's my narrative. That's why I have the narrative I have. That's why I think we're not going to go to all-time highs yet. That won't happen until we see that larger B wave we talked about, which will wrong foot again most of the masses before something entirely I don't know what to call it, different will happen again that will bring stock prices down tremendously. I mean, that would be if we go back here, I mean, this crash, I cannot even fathom and imagine what the cost will be or how fast and furious it will be, but it will probably
well, we just have to concern ourselves for now what might happen next year.
So what's concerning is about this. This week, we cannot position ourselves for it. We cannot be bothered about it. I might be wrong. I don't think so, but that's something entirely different. When we get there, we'll deal with it. And after that, the bull market will resume. And I think there will be many decades of good times ahead. This is not the end of the world, not the end of society. We just need to go through probably a large correction to get rid of all the froth and excess we've had in the markets and in society based on quantitative easing, zero interest rates, and that type of stuff. The easy money is over, and that's normal. We need to get rid of it to kind of come back to a more healthy, in my humble opinion, healthy free market society where we don't have the constant injection of artificial money by one institution, but we need to get back to simple market dynamics.
Getting back to normal means
yes,
taking the pain finally, and Arnout Schure rests his case with confluence of seasonals, GAN, and Elliott wave, and great narrative you laid out for us. Appreciate your giving spirit to lay it all out on the table for us, Arnout.
Oh, you're welcome. You're so welcome. That time just flew by.
Okay, well, yeah. It's always great having you, and love your case. What's your doctorate in, Arnout?
Environmental sciences.
Okay. Yeah.
Yeah.
All right.
So I'm a numbers guy. I love numbers. Just a scientist. And these numbers speak.
Global warming or a mini ice age coming?
Oh, currently global warming. Absolutely.
All right.
Yes.
I'm in the ice age camp. Anyway, so I'm crazy. Anyway, Arnout, it's really been great talking to you, and
likewise. Thank you.
My trading warrior brother. I wish you success on executing your narrative, and all the people that you work with and guide, that you guide them through these treacherous A, B, C, D, E, F, G, X, Y, Z.
Yeah, it's been something. Ooh, wow, it's been fun too. Absolutely.
And the best way people to just reach out on Twitter at Intel_invest, and you want to give your web, and that's your right there, and then your website is Intelligent Investing. Is that it?
Yeah, intelligentinvesting.market.
Oh, .market. Okay.
Yeah.
So check Arnout out, and the roadmap he put out here could change, but every once in a while it's good to have guidance from someone with experience. You can't learn it, but you can learn from those that have it.
Thank you. Very well said, Dale. Thank you.
All right, buddy. I'll be in touch with you on Twitter. We'll talk again this summer.
Wonderful.
See how things are playing out. And everyone here, thank you. I hope you enjoyed Arnout, and you could join the team in 11 minutes on the morning edge. So go take a shave and get ready for the edge with the team. And I'll see you tomorrow for Turnaround Tuesday. Arnout Schure, thank you for your time today, buddy.
Thank you, Blake. It was a pleasure. Really fun to do. Okay.
I'll be Blake for right now. I hope he doesn't mind.
Did I say Blake or did I say Blake?
Yeah, he said Blake. It's all right. Sorry. I'm younger now. I feel so much younger now. Anyway, thank you, Arnout. Have a good one, buddy.
Thank you so much. Yes.
All right, man. All right. And I'll see you, everyone. And see you tomorrow. Turnaround Tuesday. Adios.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.